In 1988, Warren Buffett spent over $1 billion buying Coca-Cola stock, and Wall Street thought he'd lost his mind. The stock looked expensive by every popular metric. But Buffett wasn't looking at the price. He was looking at something most investors never learn to calculate: intrinsic value. That single decision turned $1 billion into more than $25 billion. Today, I'm going to break down the single most important concept in all of investing: intrinsic value. This is the skill that separates people who build real wealth from people who just gamble in the stock market. By the end of this video, you'll understand exactly what intrinsic value means, 3 practical methods to estimate it, and how the greatest investors in history have used this concept to make billions. Whether you've been investing for 20 years or you're just getting started, mastering this idea will change how you look at every stock forever. Let me start with a simple question. If I offered to sell you a machine that prints exactly $100 every single year, guaranteed, for the next 20 years, how much would you pay for it? Would you pay $2,000? That's a guaranteed profit. Would you pay $1,500? Even better deal. Would you pay $2,500? Now you're breaking even before accounting for inflation. That machine is a stock. The $100 a year is the cash the business generates for its owners. And the price you're willing to pay, that's what determines whether you make money or lose it. Benjamin Graham, the father of value investing, put it this way back in 1934 in his masterwork Security Analysis: every stock has 2 prices. There's the market price, what people are willing to pay on any given day. And there's the intrinsic value, what the business is actually worth based on its assets, earnings, and future cash flows. The market price changes every second. It's driven by emotion, headlines, and herd behavior. Intrinsic value changes slowly, it's driven by the actual economics of the business. Your job as an investor is to estimate intrinsic value as accurately as possible and then only buy when the market price is significantly below it. That gap between price and value is what Graham called the margin of safety. 3 o'clock. Now here's the practical part. There's no single perfect formula for intrinsic value. If there were, everyone would use it and the market would never misprice anything. But there are 3 methods that the greatest investors have relied on for decades. Method 1, the Graham Formula. Benjamin Graham created a simple formula that gives you a quick estimate. He published it in The Intelligent Investor in 1949 and refined it over the years. The formula is: value equals current earnings per share multiplied by the quantity 8.5 plus 2 times the expected annual growth rate. The 8.5 represents the price-to-earnings ratio Graham considered fair for a company with 0 growth. The 2G adjusts upward for growing companies. So if a stock earns $5 per share and is growing at 7% a year, Graham's formula gives you an intrinsic value of about $112.50. Now, this formula has limitations. Graham himself warned it was a rough tool, not a precise instrument. But it gives you a starting point, a quick sanity check before you dig deeper. Method 2, discounted cash flow, the gold standard. This is the method Buffett calls the only correct way to value a business. The idea is beautifully simple: a business is worth the total amount of cash it will generate over its lifetime, discounted back to today's dollars. Think about it this way. $1 next year is worth less than $1 today, because you could invest today's dollar and earn a return. So future cash flows need to be discounted, reduced to reflect the time value of money. Let's say a company generates $100 million in free cash flow this year, and you expect that to grow at 8% annually for the next 10 years, then slow to 3% after that. Using a 10% discount rate, which represents your required rate of return, you can calculate what all those future cash flows are worth today. That number is the intrinsic value. This is exactly how Buffett analyzed Coca-Cola in 1988. The company was generating about $328 million in free cash flow. Buffett projected that Coca-Cola's incredible brand, global distribution, and pricing power would allow it to grow that cash flow for decades. His analysis told him the stock was worth far more than the market was charging, so he bought over $1 billion worth. Method 3, asset-based valuation. This is the most conservative approach and the one Graham favored for bargain hunting. You simply look at what a company owns, subtract what it owes, and see what's left for shareholders. Graham took this even further with his famous net strategy. He would look for companies trading below their net current asset value, meaning the stock price was less than the company's current assets minus all of its liabilities, both current and long-term. You were essentially buying the business for less than its liquidation value and getting the entire operating business for free. In the 1950s, Graham found dozens of companies trading as net-nets. One of his most famous was Geico, the government employees' insurance company. In 1948, Graham's fund invested about $712,000 in Geico. That position eventually grew to be worth over $400 million. Graham didn't need a complex model. He just bought a dollar's worth of assets for 50 cents. 7 o'clock. Now, let me show you how intrinsic value works in practice with one of my favorite examples, See's Candies. In 1972, Buffett and Charlie Munger bought See's Candies for $25 million. At the time, See's had about $8 million in tangible assets and was earning roughly $4 million a year before tax. By Benjamin Graham's strict asset-based standards, Buffett was overpaying. He was paying 3 times book value. Graham would have walked away. But Buffett looked at something Graham's formulas missed: the intangible value of the brand. See's had incredible pricing power. Every year, they could raise prices and customers kept buying. The product was a small luxury, a box of chocolates people bought for holidays and gifts. Customers didn't comparison shop for See's. They were loyal. From 1972 to 2019, See's Candies generated more than $2 billion in cumulative pre-tax profits for Berkshire Hathaway, all from that original $25 million investment. And Buffett reinvested those profits into other businesses, compounding the returns further. This is the crucial lesson. Intrinsic value isn't just about the numbers on a balance sheet. It's about the economics of the business, its pricing power, its competitive advantages, the durability of its earnings. A business that earns high returns on capital and can reinvest at those same high returns is worth far more than the numbers on the page suggest. 9 o'clock. Here's the part most people miss. Even after you've done all this work, run the Graham formula, built a discounted cash flow model, analyzed the assets, your estimate is still just that, an estimate. Graham insisted on building in a margin of safety. If your analysis says a stock is worth $100, don't buy it at $95. Wait until it's selling for $60 or $70. That gap protects you from errors in your analysis, unexpected business downturns, and the general uncertainty of the future. As Graham wrote, the margin of safety is always dependent on the price paid. You don't control the quality of the business, you don't control the economy, and you certainly don't control the stock market. But you absolutely control the price you pay. 10 o'clock. If there's one thing I want you to take from today's video, it's this: the stock market doesn't tell you what a business is worth. It only tells you what people are willing to pay right now, and those two things are often very different. Your edge as an investor isn't speed. It isn't inside information. It's the discipline to estimate what a business is actually worth and the patience to wait until the market gives you a price well below that value. Buffett has said that if you can't estimate intrinsic value, you shouldn't be buying individual stocks, and he's right. But the good news is, this is a skill anyone can learn. It doesn't require an MBA or a Bloomberg terminal. It requires clear thinking, honest analysis, and a healthy respect for what you don't know. Tomorrow, we're going to take everything you learned today and apply it to a real company. I'll walk through a full intrinsic value calculation step by step so you can see exactly how it works in practice. Make sure you're subscribed so you don't miss it. And I'd love to hear from you. Drop a comment below and tell me, what's the biggest challenge you face when trying to value a stock? Is it finding reliable financial data? Building projections? Knowing when the margin of safety is big enough? Let me know, and I'll address it in an upcoming video. This is educational content, not financial advice. Always do your own research and consult a qualified advisor before making investment decisions.